Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Welcome to episode number 31, the launch framework, 30 points of action readiness built into the exit ratio 360 system. And what you need to know is you can pass every readiness test in the book and still never actually start. Because wanting to sell and being willing to do all the work necessary are two completely different commitments. You've got some decisions to make. And launch stands for leverage, action, capacity, urgency, now cost, competitive window, and hesitation pattern. Now, you can be after the maximum multiple, or you can just say, hey, Scott, I really want to grow my business to be more profitable. It's in here. Here's the thing. You can pass every readiness test in the book and still actually never be ready to start, because wanting to sell and become willing to sell are two different things completely. And you have to know that. I don't know how many times I talk to business owners, entrepreneurs, practitioners, and they're like, Scott, I want to sell, but they really haven't made up their mind. So action readiness is not motivation. It's measurable capacity across commitment, clarity, bandwidth, and your decision to move forward. And if any of those 4 are missing, your exit prep stalls. And then you lose time that you can't get back. And I do want to mention that, you do have a launch window. You do have a window of opportunity for you to make moves, for you to get the maximum multiple. And in order for you to have the best ability to get the maximum multiple, you want optionality. And that's going to start with the decision. Like, this is where launch comes from. Because we went through ready, but now we are into launch because that's what you got to do. You're going to find that buyers, they evaluate momentum. And they look and they're like, hey, when did you start preparing and how much progress have you made? And they come to you and they say, hey, we see that you've been on the same path for the last 18 months. What's going on? Can you show us what's changed? And if the answer comes back to hey, we've really been thinking about it, that's not prep. That's conversation. It's hesitation. And the buyers, the private equity, the investor group, they're going to see it as a signal that you're not really ready. They're going to see it as you're on the sidelines. And if you have an account executive, if you have a salesperson that you're meeting with, another fancy name for account executive, they might move you down on their list. Right? They're ranking it just like a sales process. Hey, where is company X at? Where are they at on this process? And if it's a big private equity firm, if it's a family office, if it's anything similar, then they have what we're going to refer to as a war room, and they're going over deals. They're like, hey, here's the deal on the East Coast. Here's the deal on the West Coast. Here's the deal in the Midwest. Here's the deal in the Pacific, and here's what we're looking for. They're not ready to go just yet. And so this holdback on your part, this hesitation, can take you from an A-level deal, an A-level company, practice, or office to a B or a C if you're not serious about moving forward. There's problems that hide, and there's 3 of them. And the first is commitment without calendar. So, hey, I've told myself I'm committing, but you haven't blocked off time to really think through or have the conversations with the professionals. My belief, if it's not on your calendar, it's not blocked off, it's not a commitment. It's a wish. Second, clarity fog. You don't know what to do first, second, or third. So everything feels urgent. Everything is chaos. And where there's chaos, there's confusion. And then third on this list is bandwidth denial. You're running the business, the company, the organization, the practice 12 hours a day, and you've considered or believe that you can bolt on exit prep to everything that you're doing, and you can't. And launch will help you measure if you've got that figured out. Your buyers, they're going to detect it. And the way that they do that is they're saying hey, you've been talking about selling for a year, but the financials still aren't clean. The SOPs aren't documented, and the management team still can't answer questions independently without looking at you to validate the answer. So they're looking and they're like, hey, the preparation was performative and you didn't do what needed to be done. Excel Eddie looks at the timeline between what you say and where you're at, and what's actually changed and starts making notes in the Excel file. And when buyers see low action readiness disguised as high intention, they assume the business will just be a slow transition to post-close. And they start considering dings and dents on your part. Now, this is not an absolute, right? But I'm giving you the common background of what to expect. And if you're saying, hey, Scott, I really want the maximum multiple, then what you need to know is there's going to have to be a signal from you that you absolutely want to launch and that you are moving forward. Now, just because you move forward and you take the path of, hey, I really want to sell my business, doesn't mean you have to at the end of the day. But here's what's going to happen as a default. You're going to run a better practice, a better operation, a better office, a better organization, whatever term you want to use for it, whatever industry that you're in, because you've put everything in place and that accountability is there, which, by the way, is one of the biggest reasons why somebody wants out and they want to sell is there's no accountability. Not to the extent that they need so that they could go away for a month or for a quarter and have the company operate just as good or even more profitable without you. I like to talk in terms of launch windows because, everybody understands that. From the time that there was the space race, like, you got Cape Canaveral and you're like, hey, are we ready to launch? Do we have time? Is there time available to get us through this window? Well, you also have to consider for what you're looking at is valuation penalty. Every month that you spend in preparation mode without making measurable progress is a month without improvement. And by default, you're moving backwards. If your ideal window is 24, 36 months out, you might be burning some time. And your buyer, your investor, private equity is going to take a look. Fewer improvements over time can lead to a lower score for what that company is willing to give you on your exit. Or it may be a bigger holdback, a bigger clawback later on at the end because they're like, hey, you weren't ready. And you want to look through the lens of, hey, how is private equity, a private investor, a buyer group going to take a look at my organization? They're evaluating risk. They're saying, hey, how much risk is here? How much do we believe that what you say is going to happen after the deal is done? And the more belief that they have in you, the higher the possible valuation. And I say possible because I don't want to make a guarantee that I can't keep. So if you start thinking in terms of what your multiple could be, or turns, whatever way you want to say it, multiple or turns, depending upon the chaos in your organization, you may be on slate for a 5-time multiple, but then private equity buyers group comes in and says, we're going to have to take one of those away because it's not running the way that it's supposed to. Right? In the car example, you got some dings and dents. The paint job needs some fixing. The tires are bald. Excel Eddie, Excel Edwina, they're going to find this. Your account executive, whoever's running the deal, they're going to know. I will point something out to you. If you've been around sales, you've seen enough deals. You know a feel of a deal. You know when somebody's making something up. You know that. You've done enough negotiations that your BS detector picks stuff up. I'm going to share with you, like, when you go to sell a company to private equity, to a private investor group, or to an investor, chances are pretty good that their team has seen just as much as you, and like, you're not going to snowball. I'll share something with you. I was in a deal a while back ago, and the other side was playing games. And they kept saying to me and my team, we're ready, we're ready, we're ready. They had not decided to launch. And so, what happened was, okay, so we put them on the calendar. Let's have a conversation. Now we're not ready. We put them on the calendar again. It signaled to us they weren't serious. And then when they said, hey, we're serious and we're ready to go, we were already knee deep in other deals. And we decided to pass on the deal because we found other deals that were better. And so for you, the question is, how good is your deal? You want the deal to be like, we're salivating over it. We don't want to leave this deal alone. The deal that me and my team found, we're like, yeah, we want it. We like it. We love it. We want some more of it. And then the feet dragging started. And then we're like, we don't need this. There's plenty of other good companies on the market. And this is a good stat for you to know. For every buyer out there, there's 10,000 deals. And so, like, there's only so much waiting that can be done. Like, Yeah, I really want the company. I really want the organization. I really want this deal. But at the end of the day, if you're 1 in 10,000, and I don't mean this derogatory, if you're 1 in 10,000, like, that's something to really think about. You want to be that 1 out of 10,000 that people are like, we're going to chase you for it. We ended up giving up on the deal because it really wasn't as pretty as it was made out to be. And message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. There's also a secondary consequence that most people don't think of when it comes to your launch. Your team may not take you serious. You're like, hey, we're ready to do this. And then everybody's like, oh, we're on board, coach. We're on board. Let's do it. And then nothing. It signals to them that it's not serious. And sometimes the accountability scores inside of an organization are going to go down. That means that documentation, SOP processes stall out. Improvements get deprioritized and like, we're not really doing it. And the urgency that you need evaporates because they're like, we just don't have to deal with this right now. You were hoping for the needle to move, and it either dropped or it didn't move at all. Dings become dents, multiples drop, turns drop, and at the end of the day, you are after the maximum multiple. You deserve getting the most for your company that you can get, and you should, as long as everything's in order. But now you've got a culture of procrastination, dragging their feet, and then you've got to rebuild, and starting that process changes your launch window that you used to have, The ripple effect, it reverberates across your outside team. You may have a CPA, you may have a consultant that you're working with. You may have an M&A attorney, and they're sitting there going, hey, we thought that this was supposed to happen. And they start pushing back your deal and start working on other projects. They're like, hey, this timeline is soft. They lower their expectations and they start saying, hey, we're gonna move time around to what's available and we'll get back to you. So when it's time to go to the market and your team needs to be calibrated, they're not ready to go. We're not talking the inside team, we're talking the outside team, which can lead to fewer improvements, weaker positioning, less buyer interest, and less competition. That's going to lead worse terms. And then just everything compounds and snowballs from there. You want the best advantage. You want the maximum multiple. And the only way that happens is from you deciding, like, this is a priority and we're going to do it. What you're going to find is the launch system scores 30 points across 3 dimensions: commitment, capacity, and clarity. Commitment, capacity, and clarity. Commitment measures whether you've made real observable decisions that signal, hey, I'm ready to do this. I'm not just thinking about it. Like, we're on the path. We're going to do it. Capacity measures whether you've created enough bandwidth in your schedule and organization to execute the preparation while running the business. And that takes effort because, it's a new shiny object for you. And clarity measures whether you have a sequenced plan. What happens first, what happens second, what happens third, and everything depends upon that. So I'm going to challenge you. Score yourself honestly. Like, where are you at with this? Where is your commitment? Where is your capacity and where is your clarity? And if it means that you got to go sit by the river, by the ocean, by the beach, get a hotel room for a day for nobody to bother you, turn your phone on airplane mode, and then go through the scoring system and figure out, like, realistically, where am I at? Where am I at on my commitment? Am I in? Like, on a scale of 1 to 10, 1 being you don't care, 10 being you're in, where are you at? And your capacity. Do you have the actual bandwidth to do this? 1 being like, I don't have capacity. 10 being I've got plenty of capacity and my team can take care of what needs to be done. And then clarity. Do you have a plan? Do you have a playbook? There's other playbooks out there. I'm not the only one. Right? For me to say, hey, I'm the only person that can help get you, that I would be completely making stuff up. But please, for the love of everything, get a playbook so you do not leave money on the table. That when you exit, you're getting the maximum multiple. It could be the difference between you buying a house on the beach and you going for vacation for a couple of months. To me, buying the house on the beach is the way cooler story. Or, mountains. I'm an ocean dude, so I'm going to pick the ocean every time. Someone's like, hey, Scott, you want to go to the snow? I'm like, no, the word no is in the middle of the snow. That's not fun for me. It's too cold. I don't like wearing shoes. The chain's going to break where the weakest link is. So really go back and ask yourself, what's your commitment? What's your capacity? And what's your clarity? And this is something that I wouldn't say decide in 5 or 10 minutes. I would really think about it. I would put some time aside, like I mentioned. Go to the beach, go to the ocean, go to the river, put your phone on airplane mode. And I shared hotel room. If you haven't ever heard me talk about this in any of my episodes, there's been times where I will go to a hotel and rent a room for a day so that nobody can find me and nobody can bother me. And most of the time, hotels are really quiet during the day because most people check in around 4 and they leave around 11. So like that sweet spot of 11 to 4 or 10 to 4, if it's not a busy day, you can sneak in and just tell the hotel manager, I just need this till 5 o'clock. Sometimes they'll make a deal with you. Sometimes they won't. If it's not a busy season, they're like, game on, we'll take the money. There's been times where they're like, hey, Scott, we're booked. We can't do this. I'm like, do you have a boardroom? Can I get a boardroom? And then if they've got a bunch of this is all about wheeling and dealing, just so you know. I'm going to tell you a story. Right after COVID, I took my mom to Maui, and there was nobody there. There was literally nobody there. And so they had open cabanas. And the cabanas, I think they rented for like $1,200 a day. Let's say $1,200 because it makes the story easy. So I went to the manager and I said, hey, there's nobody here and you have these amazing cabanas. I'm just kind of curious. What kind of rate are they? And the manager says like they're $1,200. And I said, I'll give you $250. And the manager says, why would you do that? And I said, because I'm a nice guy and nobody else is going to rent them. And so you might as well make some money instead of no money. And the guy kind of laughed and he said, only because you asked politely, right? So be aware that like on low traffic times of hotels and restaurants and places that you need to go, you can have these conversations that work to your favor. As you decide to move on with your exit, as you decide to move on with your sell, it's going to require your team to be involved. Now, they may or may not know what is on the time horizon for you. And if they do know and you're going to tell them, I'm not a doctor, attorney, marriage counselor, or therapist, but I would get them to sign an NDA first before you disclose plans. And I would throw them a little bit of money to say, hey, listen, for you to be around for the exit, this is what I'm expecting. And these are going to be the roles and responsibilities for you when I leave. Like paint the picture that they're going to be around because that's what private equity, your private investor or your buyer group wants is they want the people to stick around. And so you want cadence, you want information on where progress is. And they're going to have a decision band to make decisions. They're going to make bad decisions. They're going to make good decisions, just like you've made bad decisions and good decisions through building your office, through building your business, or building your practice. If the preparation only lives with you, then it's only a priority for you. If it's being project managed by somebody, you have a bigger opportunity to making some magic happen. And if it's treated like an important initiative or like it's really supposed to get done, then you have a higher chance for that maximum multiple. So you're like, Scott, how do I do this? Well, you create a 90-day prep plan. 12 weeks, 3 milestones per month. And every milestone is specific and measurable. It might be improved financials, but defined. Like you're going to want to say, here's what we're going for. We're going to improve EBITDA by week number 3. Where possible, right? That might be impossible in your industry or what you have to offer. But where possible, you're looking for the biggest action movers that are going to help you get the biggest multiple. You're going to look for the numbers of scores that have improved month by month. So this is why I'm a huge fan of saying, if you're going to sell, your best opportunity is to start 5 years out, 4 years out, 3 years out, minimum of 2 years out. Because if we go down this path, 5 years is 20 quarters, and 20 quarters goes by fast. 4 years is 16 quarters, and 4 years goes by fast. The more time that you have for your improvement, the better off you are. And your launch window can be modified. The market moves. Your multiple is going to move. Before COVID, it was the biggest multiple at the time that you could get for a business. After COVID, they went down significantly. In 2024, 2025, they normalized. Moving into 2026 and beyond, who knows? It only takes one interest rate change to change the multiple. Because money, the less expensive or the cheaper that money is, the more that private equity, private investors can buy, because they're getting money on loans. If you didn't know that most private equities run on a 5 to 7 year thesis, right? They have a 5 to 7 year plan. And then at 5 or 7 years, they sell off. So they get investors, whether it's institutional or people who have money, high net worth individuals. And they say, hey, here's our thesis. Here's what we're planning to do. Here's the type of returns that you can get. Now, there's a lot of private equity out there that gets 21, 22, 23% return rate on their money. Some of them don't. Some private equity companies will go out and buy companies, and they'll have 30, 40, 50 companies in their portfolio. And then what happens is they'll sell off the underperformers. They're still good companies, but they're not meeting the rate of return. They're not going for the thesis. And so you need to know that, like, this is how it operates. Okay? If people say, hey, Scott, how do companies get bought? Well, that's part of it. People will bring in investors, investment funds, private investors, high net worth individuals, and say, here's where we're at. We'll pay you 15, 18% interest to get us to this point because we're going to plan on selling in 5 or 7 years. That's how it works. And the goal is to stack a whole bunch of these companies up, and then one company takes care of HR, and then one company takes care of fleets, and then, or one office, I should say. And so you're maximizing the roles across the company. So if you've got 20 companies in the portfolio and only one is HR, one organization takes care of HR for all 20 of them, you've made the money work better to your leverage, because now that office takes care of everybody. Whereas it was super inefficient to have 20 different HR managers and 20, like, you start thinking if you could outsource a department and fractionalize it across 20 companies, it becomes highly profitable. All right, got a self-test for you. If you're serious about the launch, you're serious about, taking your company and getting it prepped to exit, open your calendar for 30 days and count the hours you have specifically blocked off for exit prep work. Not running the business, not client meetings, not ops, exit prep. Documentation, system building, leadership development, financial cleanup. That one's super important, by the way. A lot of companies, I say, hey, that's where you really need to start, is the financial cleanup, because that's going to be your roadmap. Almost every company that I go into has some sort of time lag on accounting. Not every, almost every. And it works to your favor to know your numbers and have your numbers. And if your number is under 10 hours for the whole month, your launch score is telling you something that you need to hear. It could be that you haven't committed. You don't have the capacity. You don't have clarity on what you want to do. Figure out which one it is, and that's your starting point. Okay, here's what you're going to do. You're going to pick one of the 3 launch dimensions: commitment, capacity, or clarity. And whichever scored the lowest in your gut right now is the one you're going to work on. This week, your role and responsibility is to take concrete action in that dimension. Block 4 hours off in your calendar for prep work. I always found that Friday afternoons is the day that most people really don't get much done. Like, here's what happens for a lot of organizations. Most people straggle in on Monday morning, and they're not really good until about 11 o'clock, for whatever reason. And then most people start deciding, hey, it's 1 o'clock on Friday. I'm out. I'm done. I don't need to do any more work. Like in Hawaii, they call that Pauhana Friday, and then they're at the beach. So if that's you and you're like, hey, I have some time off on Monday mornings or Friday afternoons, figure out what you're going to do with it. One action in the week to figure out what's going on. Not next quarter if you're serious about launching. It's the difference between, could be 1 or 2 multiples return on your exit. And like, it's your business. You've worked all this time. You put in this energy, this effort, sleepless nights, the employees who left. You deserve the biggest multiple that you get, and that starts with you launching. We will see you on the next episode. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, Subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.